Let's move on to part two, and it's about breaking down the VIX, and it's very much a quantitative subject. So the VIX, as we know, is a very popular index. CNBC, the financial news talk about it all the time, and there are tradable futures an option. It's become a liquid market, but when you think about it, it's, I think, a very abstract contract. When I think about it, it's the future of the volatility implied in the futures. But we talk about this because, again, based on a YouTube poll that I've done, there were 500 people that voted in favor of talking about the VIX, and therefore that shows how much it's part of, let's say, popular culture, if you want, although it's a very technical subject. So let's just start, if you don't mind, with volatility basics. What are we talking about? The realized and implied volatility. If you could give us a quick primer.
Yes, absolutely. So when talking about volatility, you first off have to differentiate the two concepts, as you mentioned, which is realized volatility and implied volatility or future expected volatility. Realized volatility is the principle which is relatively straightforward to understand, which is you take a time series of any financial observable. In our case, we might pick SPX as the US stock index, and we look at the daily movements of SPX over a given period of time. We measure the log returns, we sum up the log returns, and we arrive at a figure that we call realized variance or realized volatility. That's the past realization of uncertainty of SPX. Now, how does this uncertainty of SPX manifests itself in the future? And there are tradable instruments which give you the market implied expectation of future uncertainty. And these instruments, these future instruments, SPX, put and call options. Put or a call option is an instrument which allows you to exercise SPX at the future point in time, or which is an instrument to buy or sell SPX at the future point in time. Now, the principle that underpins and really links the notion of a put and a call option to future expected volatility is that these put and call options can be translated into something that is called implied volatility by means of the famous Black-Scholes formula. And implied volatility, so what you get out of that is that for SPX in particular, at various points in the future, at various maturities in the future, you will have put and call options traded, and each of the put and call options at each of the maturity is traded over different strikes, which you would typically call a strip of strikes at future maturities, which gives you an implied volatility surface for SPX over the two dimensions strike and.
Again, going back to the core of this, and why would someone, it seems to an outsider, it might sound funny that we want to trade or to get access to something that is a calculated thing. Like no one trades, the moving average or things like that. But here, there is I think the attraction towards volatility is it's tend to be inversely correlated with the index.
Well, one way to analyze this for an individual underlying of SPX, let's pick something prominent which is even able to default, such as Ford. But what you will find in this paradigm is that when you have an equity and the price of the equity goes up, the leverage in the company goes down, so the stock becomes more certain. And when the stock price goes down, the leverage, i.e. the equity over debt ratio of the company goes up and volatility goes up. And this is very practically manifests itself in the future expected volatility of those individual underlyings, where picking the example of Ford, you will find that implied volatility levels for any typical equity, single stock equity underlying. The implied volatility for low strikes is higher than for high strikes, which give you an indication of this inverse correlation of stock versus volatility movement. The inverse correlation for equity is something fundamentally inherent in principles of corporate finance, and it's effectively from there on. I mean, it manifests itself through the leverage ratios of companies and the associated volatilities.
And from my experience in sales, in derivatives, a lot of people want to access that because if you know this is decorrelated or inversely correlated, so it means it goes up when your portfolio goes down, well, it's a very attractive proposition. However, it's really not a straightforward thing to access. And can you tell us a little bit about the challenges there?
Yes, absolutely. So the principle of having decorrelated assets is a fundamental proposition of modern portfolio theory, where you say, I pick two decorrelated assets, I build an efficient frontier, and my portfolio sharpe ratio will increase. So looking for hedges, looking for ways to diversify your portfolio is something very fundamental in the principles of portfolio investment. Now, trading volatility is far from straightforward. We have the concept of realized volatility that's not a tradable asset. We have the concept of put and call options, which we just started to explore, which have the notion of an implied volatility. But buying a put and a call option, whilst giving you exposure to volatility, doesn't translate one-to-one into a consistent future position in volatility itself. And that's relatively easy to understand. If you buy a call option, you're first faced off with the fact that you have to delta hedge your call option, but equally too, the gamma or volatility exposure of the call option diminishes with movements of the spot away from the strike. So you might think you bought a call option and you bought yourself some volatility exposure, but if the spot of the underlying moves away from the strike, you might be left with very little volatility exposure. And this is really the starting point for over-the-counter products emerging, which give you outright exposure to future implied volatility. And the instrument that does allow you to do this is a variance swap. You're looking for an instrument with which you can trade volatility, and variance swaps have been the first instruments to emerge, which allow you to get exposure to effectively trade future implied versus realized volatility.
Indeed, so variance swaps have been available, and I would say this is typically something for institutional and very sophisticated investors. What we see, what everyone can see in the market is the VIX. Can you tell us a little bit about, why someone wanted to develop an index like that?
Absolutely. So the rationale to develop something like a VIX index is relatively simple. The VIX index gives you the expected volatility in the future. So the VIX, or the formula of the VIX, mimics the constitution of a variance swap and is thus measuring the market expectation of future volatility, taking into account the fact that implied volatility, is not flat but has a market skew. So the VIX index, for the VIX index, you take a weighted portfolio of options around the 30-day mark. The weighting is both with regards to time, because you not always have options expiring at the 30-day mark. And the weighting is equally in strike in order to mimic the principle of replicating a variance swap. And then the VIX index is effectively telling you how much volatility is in the respective short-term option market. That's the index level you can calculate on a day-by-day basis. And it's really what makes up the headline figure. I want to know how are the volatilities in the market that I see today. Now, the VIX index itself is not a tradable instrument, as you pointed out, but what is tradable, VIX Futures, to exercise into the VIX at various points in time. And they're not even exercising into the VIX. What they deliver as a cash equivalent at maturity is the replication of those underlying option portfolios.
We're going to go back into these terms, to the fact that they're futures and that there's a term structure and in contango. But before doing that, I wanted to highlight the fact that it is on the S&P index. We managed to create liquidity out of something that is quite a complex calculation and try to understand why it's possible on the S&P index.
Yes, absolutely. And you picked the right point, which is liquidity. So for volatility indices to exist, what is absolutely crucial is that there's a very liquid underlying option market. If liquidity in the underlying option market moves away, the volatility futures itself become very hard to follow, and you find yourself in a situation where there might even be more liquidity on the volatility futures than on the underlying options itself. Something akin to the tail wagging the dog, if you wish. The second point on the popularity of VIX on S&P is really that it gives you, is the popularity itself. S&P is one of the biggest indices in the world. There's lots of liquidity on their options, but there's also a very strong interest in measuring volatility. On VIX represents the uncertainty of world.
We talked about the VIX, we talked about the fact that liquidity issue, and there's been times when it was said that, like you mentioned, the tail was wagging the dog, and to hedge the VIX, they had to move the market. Well, no, I'll just conclude that. How does the forward curve of the VIX look like, please?
So what you will typically find is that the future curve of the VIX is in contango, i.e. the shorter dated are trading below the longer dated ones. One explanation to that is that if one does look at the time series of VIX, you will see two paradigms. One is that VIX is clearly mean reverting. So the VIX index might drop to levels of very low volatility, but equally too, VIX has seen periods of significant spikes. But over the long term, VIX is trending to the mean. And the spikes, the upward spikes are significantly more pronounced than the downward spikes. So what the upward sloping future curve of VIX is really telling us, and what one very commonly sees that contango is manifest, is that the short-term future is trading at a lower price than the long-term future.
And what that means is that we go back to our initial point, which is people want to get exposure to volatility because it's inversely correlated and therefore to their portfolio, and therefore they want to be long volatility. It constitutes a challenge, right? Because if you want to hold your VIX position, you lose money systematically because you have to buy high the future contract, sell low the nearby contract.
Absolutely. So there are instruments. So now we need to delve into what can I trade? What are the instruments I can trade on the VIX index? There are the outright futures. Typically, that's institutional investors trading these because the block size is higher, the transaction cost. The two things that people trade on VIX are exchange traded notes, and these exchange traded notes follow certain rules. There is VXX, which is a long only portfolio of the first and second month future, rolling the position or rolling the weighting of the portfolio from the first into the second. And as you said, if you do this rolling from the first into the second month future, you will face that you're effectively paying the contango of the VIX. You're buying high and you're selling low. You're selling low the front month future and you're buying high the second month future. Let's maybe then delve into the opposite strategy, which is exchange traded notes. And exchange traded notes come in all form or fashions, and there are also a lot of inverse or leveraged exchange traded notes where the exposure is not linear, but the exposure is negative, like a short position on the return, or where the exposure is even leveraged 2 times, 3 times level of the respective portfolio return. So you then could argue that the contango of the VIX lends itself perfectly to an inverse leveraged ETF. And on the VIX, this ETF existed, which was the XIV. The problem with this inverse leverage is everything is fine until the contango collapses, and the contango collapses in the event of a crash, in the event of VIX exploding. And that's precisely what happened to XIV. The VIX exploded, the front month future moved significantly faster than the second month. And all the gains, all the contango gains that the XIV was accumulating were wiped out in the period of days.
Put its issuer, Credit Suisse, in a little bit of trouble. And I think what I also would like to get to, of course, this podcast is really not about investment advice, but I think there's some common sense that we can draw from there, is that if you just want to be long on a permanent basis, well, it's losing money, and short, well, there's this day, the XIV.
Yes, absolutely. So neither of the strategies, sitting in a long position on the rolling of on the VIX futures, that will effectively statistically systematically erode your gains through the contango of the VIX. But equally too, with the inverse product XIV, you're exposed to sharp spikes. You're also exposed to inverse leveraged ETFs systematically having to lose money through gamma, that neither of them is a sit and hold instrument for volatility exposure.
If we try to, as a conclusion on the other hand, can we go back to what, let's say, sophisticated investors would do? And I think you mentioned already that people trade the future of the VIX, but well, whether it's for skills required or the size of the minimum ticket, this is for large and sophisticated investors. And what other tools are available? We mentioned, for example, the variance swap. Is that what a typical, again, sophisticated investor would try to use?
Well, as an institutional investor, you always have the opportunity to call your favorite investment bank and ask them to structure volatility, even longer dated volatility exposure to whatever your investment horizon requires you to do. As we all know, that's an expensive exercise, but what you're effectively transferring is the active management of volatility exposure, the look into the market, maybe even rolling portfolios of puts and calls with the respective management of deltas, with the respective rebuying and selling, and where you just offload all of this dynamic management of volatility to an investment bank, or you're sitting in the position where you want to be exposed to volatility on an ongoing future basis, but then you have to trade volatility. You actively have to trade in volatility in order to keep your exposure in the market.
Thank you, Christian. I think my personal conclusion on this, being so much involved into fintech, is that there are some things that have become democratized, easier to access. You can now buy private equity via an app. The VIX and volatility is something that will remain for sophisticated investors, and it's fine to leave it like that.
Thank you very much.
Thanks for listening. Don't forget to subscribe on YouTube or on your favorite podcast player. You can also listen to Christian talking about careers in quantitative finance in the separate episode from this conversation.